Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. It's free information for your education, maybe a little bit of entertainment, a little bit of Q&A. We'll see in the chat. Thanks for being here, by the way. In this video, I'm going to get a little bit deeper into GameStop's fundamentals and how you could use that as your trading indicator. In other words, how do you know if you should or when to take advantage of GameStop volatility, hypothetical future potential volatile moments? Do you take advantage of those as it relates to your GameStop position? I'm not going to try to tell you what to do. Okay, I'm just going to try to give you information that you can use however you want to play your own investments. Okay, I'm not your portfolio manager unless you're my client and you're watching this. In which case, you don't need to watch this because I'm doing your portfolio for you. Okay, but assuming you're the general public, I'm going to give you a couple tools and how you could think about the fundamentals and kind of price targets, near-term price targets, assuming nothing changes within GameStop's current business. What's up, Miller? What's up, Trader? What's up, Burpees? Ryan Young, Moth. Great to see you guys. Glad you're here. Super excited to get into this. I was going to say something else, but I kind of forget. So let me just highlight one thing real quick, which is that using technicals as a trading indicator would be more optimal for high volume trading, obviously. And what that would mean, if you're not familiar, is basically like, hey, what price range is the stock at currently? And does it look like it's at the top of a range? And if so, will it kind of bounce back? You know, generally stocks move kind of higher highs, higher lows, although there's plenty of different patterns that stocks can move at. But basically, you would be looking at how many shares are being traded, what's the volume, right? What's the implied volatility? What are kind of key catalytic events potentially that are happening? And just where is the stock price currently compared to its historical trend? And based on that, does it look like a relatively good sell indicator or a relatively good purchase indicator? Like, is this a low or is this a high relative to its overall trend? That would be using technicals to base your trading decisions. I'm going to get into, what's up, Benjo? I'm going to get into how to use fundamentals to inform your trading decisions. And what does that mean, big picture? Big picture, it means like, hey, rather than saying, oh, GameStop's at 24.37 a share, is that high or is that low compared to where it's traded in the past 24-hour window, in the past 1 week window, in the past month, year, 5 year? Like, how does that price compare to its own price history? And how does the shape of the chart potentially give signals to what direction it might head next on a super, super short-term basis? Instead of thinking about price that way, you would look at price relative to the company's generation of profit. And based on the company's ability to generate money, what is the company worth? And how does this price relate to the hypothetical fundamental value of the company? What does this price say compared to, rather than comparing it to the historical trend of the price, rather than comparing it to patterns of charts, you're comparing it to your value for the company and the risk reward, or in other words, the probability of that value being accomplished. So I'm going to dive into one specific example to try to get it a little bit more crystallized for you, but I really want to talk with you guys in the comments, take questions, because I want this to be a tool that you can use for yourself as it relates to your GME position. And again, I'm not here to tell you to buy or sell, whatever. So this is an easy scenario to illustrate. So big picture, what if a bunch of meteors just strike all of GameStop locations and employees, right? What's the worst case scenario for this company? That's something you would want to inform yourself about. And generally speaking, what happens to almost every company if that were to happen? This would be minus 100%, right? Most companies would become worthless. GameStop actually has such a high net cash value relative to its current market cap that even in that crazy black swan event, you're only talking about a 20% decline. And the odds, of course, of that happening are less than 0.001 at the end of the day. How do I figure that minus 20%? You're basically looking at you can see the actual like formulas here and check it out yourself if you are a friend of the channel, which thanks, by the way, for friends and fans of the channel. Thanks for the subscribers. Thanks for the comments and engagement, all the above. But let me show you what this formula is doing. Basically, you are just taking the cash on the other side of the convertibles and the warrants related to what the current market cap implies about the diluted market cap. Let me see if I can make that make sense in a different way. If you wanted to say that the current share price of GameStop is already fully baking in the coming known dilutions of the convertibles and the warrants, which I'm not going to get into granularly here, but I have talked ad nauseum about how even if GameStop performs quite poorly and all they do with their cash is just make interest, right? That these convertibles will convert. And if the convertibles convert, well, guess what? The warrants are also extendable. And if the convertibles convert at 30 and that adds 4.2 billion in net cash, well, the warrants are only at 32 and they can be delayed as long as they want. So like the odds that these warrants fail to print 1.9 billion, the odds that the convertibles fail to dilute and generate 4.2 billion in net cash, to me, are so low that it's not even worth mapping out. Now, those convertibles don't convert for another 5-6 years. So when you adjust the dilution for time, you take the present value of the coming dilution, then you would say that, hey, at 24.46 a share on a time adjusted basis, assuming the warrants and convertibles dilute, that would be the same thing as 31.86 per share. Let me say it one more way. Let's say that even after 200 million more shares are in the float, let's say that after this happens, GameStop is still trading at 24.46 a share. Let's say that those shares are created, but the stock price does not change. That would imply a market cap that's substantially higher than its current market cap. It's basically a free 5 billion in market cap that's created if you can add these shares to the float without it affecting the share price, which that's what you would mean by saying the shares are priced in, or the dilution is priced in. In other words, if you could take that market cap and dilute it and go backwards, right? If you could take this market cap and say, well, if dilution is being priced in for the warrants and the convertibles at 24.46, then that means that post dilution, GameStop would be worth 14 billion, which would mean that based on the current float, GameStop is really effectively trading more like $31.86 a share. $31.86 times 447 equals $24.46 times 650. Hopefully that makes sense. I just said it about 3 different ways. If you have any questions on dilution, we can talk about it. What's up, Dank? What's up, Herman? I'm glad. They're saying it's sounding more and more complicated the more I try to explain it. Well, good. Let's move on then, because I'll just give you the answers to the test. According to me, anyways. When you assume that the convertibles and warrants dilute, if that's all that GameStop accomplishes, is the cash on hand, even though this $11 billion in cash is actually higher than the $10.9 billion in current market cap, if you're assuming that dilution is already priced in, then you're saying, well, how much less is 11 than 14? If dilution's priced in, then this 10.9 market cap is really a 14.2 market cap. If dilution's already priced in, which would be the most conservative way you could argue, right? If dilution's not priced in, then even in the meteor strike scenario, GameStop actually fundamentally could still be worth a little bit more than it is right now without any business activity whatsoever, which is just pretty wild, honestly. But if dilution's being priced in, then hey, there's a 22% decline hypothetically available, which 22% is the gap between 14 and 11, right? So that's scenario 1. That is how I figure it. I don't spend a lot of time stressing about meteor strikes ruining GameStop in its entirety. But fundamentally, if you were ever to want to lose a lot of sleep about, okay, who cares what the odds are? I don't care if it's 0.0001% chance. What is the worst case scenario? That's what this portion of this chart would tell you, in my opinion. What is the worst case scenario? Right? So let's go into the next worst case scenario. How do you value? What if GameStop fails to execute? Right? What if they do a bad job? And not only do they do a bad job, but simultaneously, the market's really crushing. What happens then? What is the price implication on GME? This would be like your hard fundamental floor, right? So this portion right here is cataclysmic events. So incredibly unlikely, but possible. And by the way, well, let me, if I don't think any of you are holding GME because of its, all 3 of these buckets, all 3 together, you could say, are all related to GameStop's high fundamental floor, right? So you have the absolute uttermost horrible floor. Is there a number that this could turn into, right? The meteor strike scenario. Is there a number that this could tell you that would be concerning enough for you to think, okay, I want to reallocate that tiny sliver of my portfolio, that portion of my GME? I don't want it to be in GME. I want it to be in cash. And maybe even net of inflation, you think cash is still going to do better than negative 20%. So if you're holding GME for its high fundamental floor, you're mostly thinking as it relates to realistic scenarios. But even at the cataclysmic event situation, you might still say, 20% loss. That's still pretty good if we're really talking that much hits the fan and we're still only down 20% fundamentally, okay, fine. But what about its realistic, like its worst case fundamental floor, the worst case floor, assuming that the business is still operating, right? The worst case floor, assuming the business is still operating, how do I figure it? Right? There's more stuff going on in the formula, right? So let me try to walk you through it, because these numbers are going to change, and that's part of why I want to talk about this with you guys. So there's 3 different figures here that have 3 different net returns. The main difference in the calculation, basically, you're looking at the floor scenario for software, which gives you a $1.3 billion valuation, plus the floor scenario for hardware, plus the floor scenario for collectibles, plus the floor scenario for power packs, plus some portion of the floor scenario of the asset management business. Let me dive into what I mean by that. So the floor scenario, in my opinion, it still values GameStop's cash at some type of premium, even if they perform poorly. That said, the difference between these 3 figures here are how bad does the asset management valuation get? So right now, with a 15% chance, I value GameStop's current assets, its current cash position, at a 1.3x. That also assumes that the warrants print 1.9 billion and the convertibles convert, right? So you end up with 1.3 times the book value on the asset management business. So 700 million of cash, I don't give a multiple to. 700 million, I say that has to be in the bank. That's insurance for the retail business. 700 million, you can't touch it. 8.7 plus the 1.9 that's coming from the warrants is cash that belongs to the asset management business. Realistically, I think Cohen will allocate this in a meaningful way, which is why in this floor scenario, I still assign it some type of premium. I've talked in the past about how even 10 billion in cash would make GameStop the largest SPAC in human history. So the odds that GameStop turns that money and lights it on fire, I think, are pretty low. And the reality is GameStop does not need to keep that money in the bank. Like it's valued at more than cash because they don't need it, right? They can use it. So if everything's going great in the overall economy and simultaneously GameStop is utilizing cash in a way that's uninspiring, basically I take 70% of that asset management business rather than the full 100%. So, and in this scenario, I take 80% of it. In this scenario, I take 90% of it. So as the economy gets worse, right, from great to good to bad, I assign a slightly larger portion of this 13.8 to GME. If the economy is roaring, I only give GameStop 70% of that value because the upside of other companies would begin to become that much more compelling and diminish some of the lure for GameStop's asset management business. So 0.7, 70% of 13.8 is 9.6. So essentially, in this little 16th here, right? There's 16 buckets total. In this bucket, I'm saying GameStop's asset management business is basically just valued at cash. That's really all there is to it. Actually, a little bit less than cash when you think about the reality that the warrants will convert to cash at some point. But if you want to say it's trading at present value of cash, so let's say the warrants don't convert for 4 years and you want to discount that and get the present value of the future cash, this scenario is saying, what if GameStop performs what I describe as the floor in all these scenarios, which every one of these little boxes could be its own video, and they have been in the past. And the point is, these numbers change. This is based on what we can see right now. So everything will get reevaluated anytime there is anything new to evaluate fundamentally. So, of course, quarterly earnings, acquisition announcements, that all changes all of this dramatically. But from what we can see right now, essentially you take cash and the float, you're still making the float this 650. So in these low scenarios, you're still assuming that basically Cohen doesn't get paid, right? You're not talking about high upside. You're not talking about exciting anything. You're just talking about GameStop's high floor. And in this high floor situation, if the economy otherwise is roaring, there's a lot of money to be made in a lot of other places. I am diminishing GameStop's asset management valuation by 20%. Let's actually round these out a little bit. Let's say if the economy is doing good but not great, we'll give them 85% of this 13.8. And if the economy is doing bad, we will give them the full 13.8, just to create a little bit more differentiation there to help illustrate GameStop's high fundamental floor. So the simplistic way of looking at it on this valuation tab is, hey, the floor, the fundamental floor right now of GameStop is $16.8 billion, which is $38 per share, according to the current share price. Or if you want to say that the current share price is already reflecting dilution, then you would say that it's $26 per fully diluted share. In other words, we're actually getting pretty close to the fundamental floor. $38 a share. And then you're basically, the dilution is essentially a 33% dilution. Because you're talking about from 447 all the way up to 650. That's a lot. Asset management, power packs, collectible, hardware, software. So 26, based on this, is like, well, shoot. What's that? That's basically a 6% upside. So how is this saying 66% upside? Particularly when I'm valuing a discount to the asset management business? Well, I'm glad you asked, because there's a couple things going on. The main difference is that in this chart, I am also factoring in the time value of money, meaning even though I'm fully valuing these dilutions, I am discounting that by the reality that they don't happen for several more years, right? So if you wanted to fully price in 100% of dilution right now for convertibles that don't convert until 6 years from now, then $24 a share right now is basically the same as $35 a share right now. Now, if you want to add in time value of money, you'd say, hey, well, 35 right now based on 5 years from now is really more like 32 right now. I know I probably lost all you guys already. So the question is, right, how do you use this as a trading signal? What does this tell you about your GameStop position? It might not tell you anything, but what it could tell you is so the first thing you would have to decide for yourself is, how do you rationalize your GameStop position, right? What buckets are you allocating funds to? And I did think of an illustration, by the way. If some of you guys are emotionally attached to GME shares, which I understand, I certainly have at least some position of shares that are totally emotionally attached. Another way of saying that is, there are some portion of shares that if someone were to say, hey, why do you invest in GME? The best answer would be, I like the stock, right? There's some portion of shares that are like, look, it's not really an investment. It's a collectible. It's a DRS book GME share. You know what I mean? Like, I just want it. It doesn't really matter what it's worth. It doesn't really matter if it makes sense. These are the shares I want, so those are the shares I'm going to have. If that is, and that is some portion of my position, but that is not reflected on this chart at all. So if that's 100% of your position, then you are truly a degen, and congratulations. And I was for my first several years of my GameStop investment. And the best way to illustrate what that looks like from an investment strategy perspective is kind of like this. Kind of like this. You're like this homeowner right here. You know, the strip center comes and they're like, hey, we're building all around this. Do you want to sell your property? We will pay you 3, 4, 5 times the worth of the property because we're going to build this strip center right here. And you are like this homeowner, diamond hands all the way to the grave. And then eventually the house is boarded up and it can't be sold for anything because no one wants it. Right? Like, it is, whatever portion of your shares are, I just like the stock, that's this is the best way I could illustrate that. And again, some amount of my shares are there, but you wouldn't really want 100% of your net worth to be completely agnostic to financial risk and financial reward and financial planning. You know what I mean? If you've got some money that's like, look, I don't really care and I don't need it anyways, more power to you and congratulations. You know, but if you've got some money that you need in your life for some reason, for some day, then you probably want to think more strategically. So this chart, this is all about strategic portions the legitimate strategic cases, the genuine fundamental reasons to support a GameStop position. This is not a video about I like the stock, but whatever portion of your shares are I like the stock, again, you don't need any of this. You already know your answer, which is just never sell it. It's a fine piece of art, a GME share. You know what I mean? Just keep it forever. Let it be. And if it goes down like this boarded up haunted house and it's not worth anything, it was all worth the ride, right? But if there's any part of you that can't afford 100% of your life savings to do that, then again, that's where this video comes in. Okay, enough of that illustration. So deciding your buckets, right? Right now we're talking about the high floor bucket. So if GameStop's at $24.42 and you're like, man, I love investing in GME. It's sorry, someone in the comments said that's the Up house. So Up was made before that development was made. So it's not actually literally the Up house, I don't think, but it's commonly described as the Up house because it made people think of Up after they saw it, which is why like even in that Google thing, there was like one of the photos was a guy with balloons. Anyways, it is and it isn't the Up house. I'm pretty sure. Sorry for the distraction. GameStop is a high floor at $24.42. That is, according to this model, still true. Right? The high floor, what I'm describing as the floor, the fundamental floor is higher than where it currently trades. The floor is above us, according to me. How this is assuming that GameStop executes poorly across all of its businesses. Right? This is the floor. And if GameStop executes poorly across all of its businesses, which truthfully, there's a good chance that even if it executed poorly in some part of its business, that a different part of its business would execute well, or that they would be able to pivot into a different business that's executing well. But if everything is operating poorly and GameStop fundamentally is still worth more than where it's currently trading, then that is a very powerful way of illustrating that GameStop has a high fundamental floor. So any portion of your shares that are GameStop has a high fundamental floor, well, then hypothetically, you are still correct. When does that become not correct? Well, hypothetically, about 66% higher based on the diluted flow, right? 66%, like 26 per fully diluted share assumes that the market cap goes up by 33%. $66 higher than 24.5 is what? 24.5 times 1.66. That's $40 a share. Now, does that mean, am I saying right now, hey, if GameStop gets to $40 a share, then you should sell your GameStop position? That's not what I'm saying. Because a couple things. One, that's not the point of this video. I'm not here to tell you what to do, right? But two, the question is, has anything happened fundamentally? Has anything changed? And that is so if GameStop right now jumps to 40 a share, and there's no acquisition news. What's up, Kevin? Glad you're here. What's up? It's two-folded. Clip grid. Lots of fun people in the chat today. If there's no acquisition news, there's no update, there's no quarter. All right, what's up, British? There's no quarterly numbers, right? There's no new numbers. There's no Power Packs Intel. There's no new business line. There's no compensation update, right? Nothing has happened. From everything we can see from GameStop's business is everything we can see right now, and it's all the same. Well, if all those things were true, right, nothing has changed about any of these valuations, any information, no new fundamental news, but the only thing that's changed is the price is at $40 a share. Well, at that point, your floor is minus 0%. Right? At 40 a share, GameStop would be trading at what this 16th section describes as the fundamental floor. What's up, John Today? What's up, Only Dads? So if GameStop was trading at 40 and its fundamental floor was at 40, would you describe that as a high floor? Yes. Yes, you would. The downside is 0, right? Now, technically, of course, the downside is always 100% with any stock. But I'm talking about fundamentally, what's the scenario? What's the valuation scenario? What are the assumptions by which you could come up with a valuation long-term of less than 40? And what I'm saying is that I can't see it currently. I don't see how the warrants and convertibles do not ultimately dilute. And guess what? When you're dealing with a company that has an $11 billion market cap, well, guess what? $6.1 billion in net cash being added to the balance sheet is really impactful. You know what I mean? If this was a $100 billion market cap, then $6 billion in new net cash would not be so meaningful. But the reality is the terms are so favorable on both the warrants and the convertibles that there's essentially no reasonable scenario where they do not ultimately convert to cash. So again, these already price in the rising float. Divided by F7. F7. Great. So when does GameStop not have a high floor? It's up to you. But if you're thinking I'm investing in GameStop because it has a high floor, I'd say like if these numbers looked like minus 20%, you know, like that's, if you're 20% above the floor, it's still like it still could be a really compelling high reward, low risk, but it's not high reward, no risk at that point. So it just comes down to what other, if GameStop was at $60 a share right now, and there was no new fundamental news, the upside might still be really compelling for you, right? It might not really affect any bit of any of these portions of your shares, and your shares might all be 100% of your shares could be related to GameStop executing at a great level and or the market totally imploding. And if 100% of your GameStop position is based on these scenarios, then the fundamental floor question doesn't matter to you. But if some of your shares exist because of the high floor, then you want to know at what point does that high floor go away? And I think honestly, as I'm processing this with you guys live, I think I should adjust these numbers, and they should actually be much lower than currently illustrated. Because 16.7 million or billion, right, divided by 650 million shares is 26 per share. So what does that mean? This 66%, 71%, 81%, these are showing you based on the current shares. They are not showing you the diluted number. They're showing you the pre-diluted number, I'm pretty sure. Now, again, it would be very conservative to say that dilution is already 100% fully priced in. But as far as I'm concerned, that's exactly what we could do. 26 per fully diluted share. So again, if we are saying that dilution happens tomorrow for the warrants and convertibles and the share price doesn't change, right? That's the hypothetical that we're talking about right now. If you're saying dilution happens and price doesn't change, then market cap just went up by 200 million times 24.42 a share. I don't think dilution's priced in yet, which is why in some ways these numbers are maybe the more helpful numbers to think about as far as the fundamental floor is concerned. But if you think dilution is fully priced in and you want to go even more conservative, then really you would adjust this down 31.5%. In other words, the fundamental floor becomes about 10% higher from current levels if nothing changes. Now, of course, things are always changing, which is the other reason why I'm saying if GameStop's at 40 tomorrow, am I saying you should sell it? Well, not necessarily, because the odds are something has changed. I might make 2 boxes of this. I kind of want to show, what do y'all, let me know in the comments, do you guys have thoughts or opinions as far as how conservative would you want me to illustrate the dilutive effects on GameStop's possible returns in different scenarios? In other words, do you want these numbers? Do you want me to assume that dilution's fully priced in? In other words, do you consider, and do you want me to consider that, hey, GameStop at 24 is basically the same thing as GameStop at 32? We're just pretending that GameStop is currently at 32, right? If we're fully pricing in dilution. If we're fully pricing in dilution, GameStop right now is basically at 32. And we think that the fundamental floor is GameStop at 38. Well, $6 more per share divided by 32 is 18.75%. Do you think that these fundamental floor figures should assume that dilution is fully priced in? Or do you think that keeping it in the current float's terms, so long as the current float is the current float, is the more helpful way to illustrate it? Let's see. Yes, Free, I will definitely be live for earnings. Super pumped. Just 2 weeks away. 13 days now. Very excited. Herman saying, didn't the dilution basically get priced in on the ARB day? I would say no. And also Tony Robbins Dinero, he says no, for what it's worth, as a bear, or whatever you want to call him, as a shill, whatever. He says the dilution doesn't even matter because it's no, whatever. He doesn't think it's inevitable that the dilution will even happen. I don't know financially, mathematically, how he argues that, though. I've listened to his arguments, and I don't agree. Herman says, I think it's easier to think about the full share count right now. So Herman thinks just act as if there are already 650 million shares when we're talking about the fundamental floor. And I kind of agree that at least in the conservative scenario, when we're talking about the floor, that's probably the more helpful trigger. All right, that's probably the more helpful illustration, is to do it in the most conservative way, which I would not include Cohen's compensation in, because in these floor scenarios, the price doesn't reach even his first tranche of compensation. Mick says, I've stuck with assumptions that all warrants will be exercised and full dilution. Okay, well, I agree. So if we take all of these, we add up the valuations, and then we're dividing it by the float. This would get us $21 per share. And then we're dividing that by the valuation on F7. F7. So why are we dividing it? We should be dividing it by F3. If we're already netting out, right? We're already basing this valuation, that $13.7 billion valuation. We are already dividing that by the 650 million float. So that price point, what we want to do is take the current price. Well, we want to take that price point subtracted by the current price divided by the current price. There you go. That's what we want to do if we want to illustrate the floor fully diluted. And now we just want to think about this assumption of 0.7. I kind of want to change that slightly. And say the asset management business still gets most of that. But M87, so M in this worst case scenario, let's see if y'all can track with this. In this, if the super macro is great, if we're in a booming market, then I'm saying that GameStop on the whole might do poorly, right? Collectibles, like we're taking the floor for everything. But if the total market is booming, then I am taking the fair case for power packs. But I'm also taking out some value from the asset management business. Does that make sense? If the economy is great, then I'm sticking with the floor scenario for power packs. Sorry, if the economy is only good but not great, M79. And then this is giving us the full valuation. M79. Boom. Boom. Okay. So there you go. If dilution's fully already priced in, what is the floor? Right kind of around where we're at. Right kind of around where we're at if dilution is fully priced in already, because the dilution that's coming is a 32% dilution. So it's basically saying 32% higher is the same thing as where we are right now if dilution's fully priced in. So at what point for you do you say, hey man, that floor is not that low? If you have some shares that are in the high floor, again, I think if this was around 20%, depending on what else you would invest in, but if these would be shares that hypothetically, like this is almost like this portion of your portfolio is almost like the GameStop is my savings account. You know, this portion right here is that house I showed you in Seattle. You know, like I like the stock. It doesn't matter. I mean, really all of this is really GameStop is my savings account. Off the charts is the house, you know. I like the stock. Don't even talk to me about numbers of reasons, you know. So if GameStop is your savings account, then hypothetically, if you weren't putting your savings account in GME, what else would you put your savings account in? And if your savings account would go in, let's just say USD to keep it simple, then let's say we hit some pretty strong inflation and you're saying, well, I want to give a 10% down a 10% downside to USD. I think my purchasing power is going to go down by 10% in 1 year. These are all 1 year targets. So again, it's always changing to reflect the present. But in a 1 year target, to say that the US dollar is going to be worth even less than 90% of what it's worth right now, that would be quite bold. And maybe you'd say, well, USD, maybe right here, I'd put some in USD. Maybe right here, I'd put some in maybe Bitcoin. Maybe here you'd put some in collectibles, right? What else would your savings account go into? And what is the risk reward of those savings accounts? If you're just talking cash and you're very conservative, then I'd say if these numbers got more than a 10% drop, then you might say, hey, like that becomes a fundamental sell trigger, not a permanent sell. But if you were to use the fundamentals as a trading indicator, then you'd say, basically, for these to show you, hey, the floor is 10% lower than it is, if that's the threshold for you that you say, I think I might want to trim my savings account shares, then you'd basically say, okay, well, what does that mean from a dollar per share perspective? Pretty much it means 10 to 15% higher from here. So let's call it 13%. It's basically 27.5 or 28. Call it 28 a share. If GameStop right now is at 28 a share, nothing's changed about its fundamentals. Then if GameStop is your savings account, fundamentally, that could be a signal for you to say, hey, I'm gonna move some of my savings account into USD in your brokerage. Now, if it's in computer share, it's not really optimal for your savings account to be in computer share. But the infinity pool, everything that you never want to touch definitely should go in there. And things that you don't plan on touching for a long time should probably go in there. And things that you are wanting insurance for the highest upside scenarios should also probably go in there. If GameStop is your savings account shares should probably be a little bit more easily accessible for you, in my opinion. I would put your savings account shares in a brokerage. Let's say it's Fidelity. I don't really care. Then tomorrow, if GameStop's at 28, nothing's changed, then you would take your savings account shares and you'd say, hey, I'm going to sell at 28. And as soon as it's back at 27 or 26 or 23, whatever you want to wait for. Again, this isn't trading. So hypothetically, as soon as it's back under, you'd say, let me start putting my savings back into my GME savings account. And if it got lower, then maybe you'd want a bigger savings account and you would take some other things and add to your savings account. But that's all within that portion of your GME. This is basically your savings account, right? One, two, three. This is your GME savings account. Right here is your GME market hedge, which we'll dive into here in a second. And then 1, 2 right here is basically your GME outperformance. GME fundamental upside, asset management, and legacy / collectibles. Fundamental upside, market hedge, savings account, aka high floor. So there we go. We took 6 buckets and turned them into 3 for you to make it a little bit easier for you to process. If you want to use fundamentals as a trading signal, just for you to be consistent for yourself. Xenon says, I don't even know or comprehend what you're saying. I just know purple donut. Come on, Xenon. Come on. What I'm trying to say is I want you to know why you're invested in GameStop. And then I want you to make, if you're invested in GameStop, I should say, and then I want you to make decisions that optimize for your reasons. Because here's what we like to do psychologically. What we like to do is say, hey, I'm invested in this because it's really low risk. It's a high fundamental floor. And then it's at 81 a share. And you know what we do? We say, did I say high floor? I meant I'm invested in this because I like the stock, right? Because I'm in it for a squeeze, and I gotta buy. Not only am I not gonna sell any at this spike, but I'm also gonna buy more at this spike, right? It's easy to change your rationale based on the price, and Wall Street analysts do this all the time. All the time. They're like, hey, we have a new price target. Oh, what's changed in the business? No, nothing's changed except the stock is worth more. So our price target looks dumb. So we're just going to up our price target. Oh, okay. So are you recommending a buy or a sell? No, we're just changing the price target. Literally nothing else has changed. That's what we do psychologically. We justify the price based on whatever it currently is. And that can lead to suboptimal decisions for you. Just in case, as if we're counting dilution now, 6 years into the future, why aren't we also compounding 6 years of interest on the cash? I mean, I am giving some premium to their cash. So I am, first of all, Justin, I am fully pricing in the cash from the convertibles as well as the cash from the warrants. And then I am giving them a 1.3x multiple on that cash. So I am, and part of the reason for that multiple is, hey, worst case, of course they can generate some more cash with that cash. But can they get a 30% return on interest? No. So I'm actually giving them more than compounded interest on cash. To answer your question, but these are all the floor. So if anything I'm saying is being interpreted as like bearish, I hope it's not. But if it is, it's like, well, think about the conversation we're having right now. What we're having right now in the GameStop is my savings account conversation is, what if GameStop executes poorly across all fronts? So in that hypothetical, right, what are the odds you place on that scenario? You might say it's very low. You might say it's only a 2% chance. I would say that's a little bit intellectually dishonest. And if you feel like it's 2%, then another way to say that is you don't hold any shares in this bucket. Like, you don't invest in, if you think there's only a 2% chance that GameStop executes poorly, then you probably don't have very many GME as my savings account shares. You probably mostly hold fundamental upside and market hedge / short squeeze shares. You probably don't have very many high floor GME as my savings account shares. You might say that, but if you think there's no way that they execute poorly, then you don't really care about the fundamental floor at all, because you don't think the fundamental floor is even possible, right? But if you give a meaningful, if you want to entertain the conversation of what if GameStop fails to execute on all fronts of its business, then yeah, it's like it's going to have a hard time going up very much. Like if they make bad acquisitions and the acquisitions don't generate a lot of profit and the stores don't sell very much stuff, like of course that would be hard for them to go up a ton unless the market absolutely craps the bed, in which case, even if GameStop is executing poorly, I think the short squeeze would take over. So there's still upside, even if GameStop does poorly, but the upside is out of GameStop's control. It becomes much more related to the plumbing of the market. But that would be different, right? That would be the market hedge / short squeeze bucket. That would not be the high floor GME is my savings account bucket. If GME is your savings account, then you could use fundamentals to say, when does it not make as much sense for that to be my savings account, to trim your savings account shares, and then to add back once those savings account shares look to be really compelling. If these rates are higher than what you can get from a CD, then you might as well hold them in GME, especially if they're meaningfully higher. And right now we're right kind of at that general threshold, anywhere from 25 to 28, based on where the business is at right now, is something like a fundamental floor. On a technicals basis, they would probably say, hey, we're already kind of high. You should probably sell some or whatever. I don't know. I'm not talking about leveraging volatility to make trades to generate income. I'm not talking about selling calls. I'm not talking about farming theta. I'm just talking about being honest with yourself about your own position, being consistent with yourself, using information that you have available to make the best decisions for yourself. Okay, makes sense? Makes sense. So let's talk about fundamental upside. And maybe before that, let's talk about the squeeze. So GameStop's negative beta, legacy short positions, right? That if forced closure happens on GME, even if the reported short interest is accurate, right? Even if we only have 16, 17% short interest, that is still more than enough to create a massive squeeze if those shorts were forced out. So what happens in that scenario? Basically, the way I've illustrated it from a fundamentals perspective is through the asset management business. So hypothetically, a squeeze could get infinite. You know what I mean? Like if it really squeezes, it can go to whatever number you want to say. Like there's no, how can you say that it couldn't? Like it's not a short squeeze is not a fundamental event. It is a technical event. So this is my attempt at illustrating from a fundamental perspective a technical event. Fundamentally, how is GameStop able to potentially capitalize on a short squeeze? Well, kind of like how they have in the past 5 years during moments of volatility. Hopefully, they could do it even more effectively, especially if the short squeeze is even more violent. But basically, all it can really do for GameStop is get more cash in the bank and bring more hype to the stock. Right? So I'm basically saying that if shorts cause spikes that lead to sales of more stock, if memes and virality lead to retail buying mania, if rumors of acquisition targets lead to rally on the stock, if a market crash leaves people running to safety and negative beta plays, right? All of these become catalysts for a ton of added value. And look at the difference. Okay. To help you illustrate this, like from a literal dollars perspective, how do I value those potential catalysts? I value that as a $60 billion valuation, right? The difference between 29 and 90, right? It's really more like 61. But still, this, a 2x net asset value and another 8 million in future capital raises, 2x current net asset value, right? So I'm not giving a 2x on the future 8 billion. I'm saying a 2x on the current assets and 8 billion in present value of future capital raises. I think this is possible from the asset management business from what we currently see, right? Once we find out what they're acquiring, maybe much more than this is possible. But from what we currently see, I think it's fair to say like, hey, a $30 billion valuation for GameStop, the asset manager, is totally in play. I do not see how GameStop gets to a $90 billion asset management valuation outside of short squeeze type events happening on the stock. But I think short squeeze type events happening on the stock could generate a ton of value for the stock. Particularly when you think about relative performance. So GameStop back here was $1 a share, adjusted for the splits they've done. They were at $1 a share. And for a day, they spiked to 81. That's not, but did they stay at 81? No, right? They crashed down. And if you wanted to give like okay, where did they really go up from $1 a share? Well, basically they went to 20, plus or minus. You want to call it 25? You want to call it 15? Fine. The real change in company value went from a $1 a share to a $20 a share company. They basically did a 20x from this short squeeze. This might make sense. This might help illustrate what I'm trying to get at here. Because you'll notice, like right here in these macro, like what if there's a short squeeze? Right now I'm showing like 300% returns. That's a 4x. And I'm telling you that hypothetically GameStop could go to $1 trillion a share, right? They could go up as high as you want. So why would you say that, oh, in these scenarios, it's going to go up to $100 a share and that's the highest price target you have? It's not really the highest price target, but that's like that's the price I could imagine GameStop settling at, trading at post squeeze. So if I was a GameStop investor in March of 2020 or July of 2020, and I'm buying in at $1 a share, or let's just say $2 a share, somewhere in here. Was it ever at 2? No. Okay, we'll stick with 1. If I was buying in at $1 a share, this would be like the equivalent of me saying back then, hey, with the coming console cycle, like, and the current short float being at 100 something percent, like this thing could 20x. That's basically what this is communicating as a signal, saying, hey, this thing could 20x. So if you're sitting here in May at 55 and it's 55x, or you're sitting here in January and it's 80x, then if you were playing GME for the squeeze, then as a fundamental indicator, you could have said to yourself, hey, fundamentally, I think the squeeze can generate a 20x. So I'm going to sell my squeeze shares at 50x and 80x with the hope and intention of buying back in, right? It's not a permanent exit, but if a squeeze on any given day can go anywhere, it doesn't mean it can go anywhere every day forever, right? Although, of course, technically it can. Any company can, you know? But fundamentally, you could say, what do I think post-apocalypse, post-squeeze? What do I think that means for where the company can trade at, where it can settle? And if it has moments where it spikes meaningfully above those thresholds, that could be a fundamental trigger. Again, not technicals. It's not drawing lines on charts. It's just, hey, this squeeze event has taken it beyond what I think is how I value a squeeze event. And so let me sell my squeeze event shares, or at least a lot of them. Now, I might still have, I like the stock shares, and you shouldn't sell those. If you have artwork, I mean, unless you stop liking the art, right? That's a timepiece. You pass that on generationally. That's what I'm doing, by the way, with 100% of channel earnings is infinity pool, right? Never touch them. You know, maybe one day they go to a trust and then I can print out certificates and open a museum one day, right? Like they're not paying. This isn't for my kids' college. This isn't for anything. This is artwork shares, right? Infinity pool. You got to love it. Where are we at? So thinking about, again, fully pricing in dilution for these figures. Essentially, we want to take the best case scenario of the asset management business, but because we're still in the company fundamentally performing bad, we're still keeping all the bad scenarios from all the other businesses. And then we're taking Cohen's compensation into consideration at this point. So now we're looking at G8. $114 a share net of the comp plan float. So if Cohen is fully vested and GameStop performs poorly across all of its legacy businesses, including collectibles and power packs, but they squeeze, and as a result, they lock in basically $90 billion of value on the other side of a squeeze. If Cohen is fully diluted, right? He fully vests. Then you're still looking at a 365% return in that scenario. Oh, sorry, I'm covering this whole thing up for you guys. Jeez. Carlum says, doesn't have to be MOAS, but I still believe there to be plenty of shorts that will be forced to close eventually. I'm here for that. Would reinvest after it sells off, given the strength of Ryan Cohen as CEO. Ideally, moving to a dividend payer, perhaps through absorbed dividends from acquisitions, whose board/overheads will cut. I like the play. I like the play. In this bottom right corner, I am basically only valuing the asset management business. I'm not valuing any of the retail. Like I'm assuming all of the other operations become worthless. And let's assume that full dilution happens instead of adjusting it for time. So let's go with F8 instead of F9. Boom. Thanks, Carlin. I appreciate it. Woo! Okay. I'm going to finish adjusting these formulas here. But there's the GME as your savings account. If you want to keep them there forever, go for it. GME short squeeze, fundamentally, if you are looking at prices above $100 a share, that's essentially when you start saying like, hey, you might want to start taking some off the table. Doesn't mean all in one swing. And that's only if you care about any of this. If you really want to be aggressive, like I'm talking about 90 billion, which if you isolate GameStop's business and you only look at their cash, I mean, their cash right now is basically 10, but then you're adding in the warrant dilution. I'm essentially saying that a 10x impact on a squeeze is possible. But we saw, well, let me rephrase it this way. I'm assuming that a 10x is sustainable. What does that mean about the peak? And is that too conservative of a sustainable? Because what I just illustrated here is that in the 2020 to modern, right, in the Cohen era GameStop squeeze, the sneeze of 2021, ultimately GameStop sustained about a 20x. Conservatively, you could say they only sustained an 11x. That's really the lowest number you could use. Or you could say they sustained a 28 or 30x. Because they did for a long time, actually. You know? So I'm saying I could see GameStop sustaining a 10x fundamentally as a result of a technical squeeze. If you think I'm being too conservative and you think that GameStop could sustain a 20x, then your fundamental triggers would be much higher. And does that mean you sell everything the day that it crosses over a 20x? You know, the day that GameStop's a $200+ billion market cap, is that when you say, okay, that's the squeeze? Well, from peak to trough, we saw an 80x last time. Is it going to be even more dramatic than last time? Do we see a 100x this time? Now, if you think that no shorts have closed and it's all being hidden one way or another, then why wouldn't you think that the upside would be even more violent this time? And if GameStop 100x's, then you're looking at a $1.1 trillion company. That's a 100x. And what's Nvidia worth? 3 something? Not that that really matters. Microsoft is worth what? 3 trillion. Nvidia is worth 4.5 trillion. Right? So if you're playing calculator on your phone and you're thinking, well, there's no way a 100x is possible because that number would just be too high. It's like, well, a 100x puts you at 1 trillion. And no, that's a 10x. Okay. A 100x puts you at 10. No. Okay. 10x, 100x. A 100x puts you at 1 trillion. Facts. 1.1. 1.1 trillion is still 80% less than Nvidia. You know, so it's not like that's just a make-believe number. And again, if we're talking short squeeze, we're not talking fundamentals. We're talking technicals. I'm trying to give you fundamental indicators that translate the technicals into fundamentals. But hypothetically, what I'm saying is if you see more than a 4 or 5x on the stock, basically if GameStop's over 100, if nothing's changed, right? All of this changes every time we learn anything about any of their businesses. All of this changes. GameStop makes a new acquisition. There's changes that happen that you have to value. I'm saying GameStop can sustain a 10x if they squeeze. If you think they can sustain a 20x, then you would hold on for a higher portion of your market hedge shares, your negative beta shares, your short squeeze shares. You would hang on to a larger portion of them for longer, right? And as far as the peak, is there a point where you just dump everything? I think we've seen too much. Personally, I think we've seen too much in the stock for there to be a point where you just dump everything. But if we cross over a trillion, if we've already 100x, well, that's again the 2021 squeeze. It got shot down. I mean, it closed at 81, so it did really like 100x, and then they turned off the buy button. So, $1 trillion market cap, perhaps for you is a threshold to say maybe take at least 50% off the table from your short squeeze portion, which the short squeeze portion might be 100% of your position. For my clients, I would take more than 50% off. I wouldn't wait for a 100x to take more shares off more aggressively, because I also won't hesitate to buy shares if they return lower. Like these signals are real time based on the real time market cap. So if we spike up and it's a signal to sell, well, if it crashes down, it's a signal to buy. It's agnostic. All of this is agnostic to your feelings about the company. It's just trying to put numbers to, okay, you think it's going to squeeze? What does that really mean to you? if you think it's going to squeeze, what does that mean? So anyways, the rest of this squeeze column, what do we want to do here? We want to take basically the same scenario, right? This one down here is asset management is worth 90 billion, but the business is worthless. Right here is business performs poorly, but asset management squeezes. Right here is business performs up to the fair case, which would be the row 87 for all of these. But again, we're valuing the asset management business the same across this whole column. Why? Oh, put the M on that. Boom. This whole column, we value the asset management business the same. But we are changing, these numbers are different because we are valuing the rest of GameStop's businesses differently. This is row 95 up here. So we get that good software, that good hardware, that good collectibles, and that good power packs, plus that good asset management. And again, all of these assume that the entire float, all of Cohen's compensation is fully diluted. It's already happened. So net of dilution, if you're assuming that GameStop right now is fully pricing in all of Cohen's compensation and all of the warrants and all of the convertibles, then in this short squeeze scenario where the market crashes and GameStop executes great, I'm still talking about net of all of those, almost 6x on the stock of what it sustains in fundamental value post squeeze events. It's just pretty exciting. Okay. I have the difference in this top column, right? Which is basically like GameStop executing great. Pretty much you're just discounting the asset management business some. So GameStop could do everything great and still not get $9 million worth of an asset management business, like a 5x net asset value plus another 20 billion in present value of future raises. Like that is not totally achievable just based on what GameStop can control. They would need some of these catalysts for that to happen. So in the top right, the best case scenario, highest upside, based on what we currently see, is basically a 6x, basically $150 a share. Again, and that's net of all the dilution, based on what we currently see. So like Solid Squeeze says, what's your price target? I'd say for me, I don't even have a long-term price target yet because there is so much we don't even see yet to GameStop's long-term fundamental value. But like if tomorrow GameStop was at $150 a share, then all of my GME is my savings account. I'd sell all of my savings account shares, right? The floor is not high at that point at all. You know, hey, GameStop is performing solid, right? I'm selling all of those shares. You know, like GameStop fundamentally outperforming outside of volatile events in the market or volatile events on the stock. like GameStop can't fundamentally just 6x overnight from what we see right now. No way. The squeeze shares, which again, for me, like the squeeze shares, like how many of those do I sell at $150 a share? Again, like what I would recommend for you, part of it kind of depends on how many shares do you have in fundamental outperformance, how many shares do you have in GameStop is my savings account, and how many shares do you have in I like the stock? You know, this guy. I would not recommend anyone have 100% of their shares in I like the stock. But that's also why I didn't make hundreds of millions of dollars like Roaring Kitty. But by the way, Roaring Kitty obviously did not just buy in DRS. Like he obviously has traded. You know what I mean? Sorry to even invoke the name of such greatness. But again, I think that's the whole point of this, is allowing yourself to let your fundamental value compared to the current value of the company inform your trading decisions. So that's really the best way I can answer that question. Up here, we want to take basically the same formula, but we want to start discounting the asset management business. If the market's bad, I still think that most of this is in play. So I'm going to give it like 90%, maybe 95%. If GameStop executes great, then I'm going to say 95% of that 90 million is still achievable if the market's bad. If the market's bad and GameStop's great, I think the short squeeze still basically happens, like essentially just as much. Now, if GameStop is great, but the market's good, I think you start to discount the asset management business a little bit more, even though hypothetically the risk appetite would be there for the asset management business. There also would be risk appetite for all sorts of other things. And I think the highest upside scenario for GameStop is still related to shorts closing. And hypothetically, if the market's roaring, shorts won't necessarily have to close if they're able to continue to make enough money in other places to where they can kind of keep up with GameStop's execution. However, if GameStop executes great, I'm still going to give this a 90%. Like I'm going to credit GameStop with 90% of this. I still think if the market's good, if the market's up 15% each year, I don't think that's enough to keep up with GameStop executing great. What's up, Orange Guy? How does your name have a check on it? Welcome, by the way. Yeah, it is usually on a Tuesday, earnings. If the market performs great, that's when I think you see this asset management business. I think you have to give a pretty healthy cut to it, maybe like only 70% of this value. Like I think the odds that GameStop can take advantage of a squeeze are, I think the value of their asset management business is lower if things are roaring elsewhere. Even 70 might be too high. Like if I do 60%, that basically gives it a $60 billion value, which is still 30 billion more than what would still be a pretty stinking strong value. So I kind of want to maybe make this like Well, if they are performing incredibly well, yeah, 60% of that's fine with me. So there you go. There's my kind of high end. I guess you could say like these are the equivalent of my price targets on GameStop's high end outperformance. The only thing that leaves us with is this middle kind of, hey, GameStop's performing really well, but it's not incredible. And there's also not anything cataclysmic, black swan for the total market. So we were just talking about what GameStop's probably about to enter into, right? That's what this middle is right here. It's what GameStop's about to enter into based on its current price target, right? It could jump back into a really compelling savings account really quick. If it goes back to 20 a share, GameStop becomes a really compelling savings account. But if it starts creeping into 26, 28, 32, it's not a great savings account at that price. But how much upside is still there at that price? That's kind of what we want to dive into here in this middle section. We'll see if GameStop can sustain the price momentum that it's been building this year. If it does, then it's officially into what's the acquisition announcement, right? What are the earnings? What's PowerPack's doing, right? It's, hey, let's look at what GameStop can control that's really moving the needle for their business, right? We start looking at how soon do Xbox and PlayStation release their new consoles? When is GTA 6 getting released? What are those sales going to be? Like, you start getting excited about the business, but you're still not talking about moonshot type events. You know what I mean? So how would I go about that? Well, right here, 087. And the question is, what do we do with the share count? I think this middle section, fully diluting, what is 130 from here? That's at about 55 a share is the implication of this. 55 a share, and that fully prices in all of this dilution. It should technically price in about 10% of Cohen's dilution. But these are 1 year price targets, which adds another interesting element to how you price GameStop's Cohen dilution, because he can only dilute according to the market cap hurdle plus the EBITDA hurdle. So even if tomorrow GameStop squeezes, well, Cohen's not going to dilute tomorrow, no matter what. And if you're basing this squeeze on 650 million shares instead of 820 million shares, all of a sudden, boom, you're looking at a 7x instead of a 5.5x. You know what I mean? And in a 1 year threshold, based on what we see right now, GameStop, like, Cohen's not hitting these tranches. So I could illustrate all of these price targets as 1 year targets and totally negate Cohen's compensation. I think for longevity's sake, I might as well leave these as illustrating his compensation. But as it relates to these middle tranches, I think sticking with the 650 is more than appropriate, because we're not going to see, especially outside of incredible outperformance, from everything we can see right now, we are not going to have any Cohen related dilution because it's going to take him longer than a year to get to these EBITDA hurdles. Now, again, if something changes, then we'll change that. Right? If he buys Target and gets to use all of Target's EBITDA, well, then all of a sudden we start to price in, hey, 20% of this dilution needs to start getting priced in our 1 year chart because it's coming. You know what I mean? And the thing is, so also we would be able to value Target, right? And Target would have its own additional value. So it's not just, oh, there's dilution and that's all there is to it. It's like, no, there would be pretty epic. I kind of want to put a 1 year. I'm going to go with the 650 for all of this. I don't know. It just looks, and I will change it. I'll change it as soon as it makes sense to change it. The 650 million share count. I am not going to net out Cohen's dilution yet. I'm going to say that these are 1 year hypothetical possible returns, and Cohen's dilution, based on what we currently see, is not really possible in a 1 year time horizon. And so the upside gets much higher that way. Now, as it relates to what's the difference between kind of good and great, again, similar to this top line, the main difference is how do you value the asset management business if the market overall is doing good or if it's roaring. So most of this could continue to happen regardless. But again, I think the ability for GameStop to capitalize on their asset management business is juxtaposed most when the market is struggling or totally tanking. So you basically take the same stuff over and you give some type of discount. Let's say 90% can happen there. And 80% happens there. Boom. Boom. Questions before I get out of here? Oh, Justin says, where did you see the earnings are in 13 days? Yeah, I guess it's still just estimated. It hasn't been actually announced yet. So it's expected to be on the 24th, but we don't know for sure. That's a good point. Pokopia game for Switch 2. Amazing results, and Nintendo is up 10% today. You gotta love that. They still holding it? Well, 6% on the day, 20% on the week. Not so much year to date. A little bit of underwhelm on the Switch 2 console, but which GameStop experienced as well. Like that drop from Q2 to Q3 in hardware was brutal. However, that's why I've been talking. I don't know how many videos I talked about the average console cycle. That's why a brand new console sells more in year 2 than it does in year 1, more in year 3 than it does in year 2, and more in year 4 than it does in year 3. The average new console increases its annual sales for 4 consecutive years before it then begins tapering off from there. The reason is because more and more games come out that make people want to get the console. You know, so super good news for GameStop. Every time there's a banger game for Switch 2, really awesome for GameStop, not just for the games, but for the consoles. I am not on X. Thank you for the question. So here you go. Hopefully this helps you understand your GameStop position better, or helps you understand how I would think about your GameStop position. Obviously, none of this is all agnostic to your personal finances. So you might be like, hey, I have $1 million in debt. I have $1 million in GameStop, but I owe all of my debt next week. At that point, it's like, well, what's your price target? Your price target is you have to sell it whether you like it or not, because you got to pay your debt back. You know what I mean? So like, not every sale, it's like insiders sell. It could be because they're bearish. It could be because they got to pay their taxes, right? So you might have to sell shares that's totally unrelated to what you think about the company. But if your shares are all hypothetically still there for the long term, it's not like you need the liquidity, then these are basically kind of the fundamental trading signals for GameStop is your savings account. GameStop is transforming as a business. And GameStop is an incredible market hedge and or is going to perform so excellently that it will force shorts to close, right? Fundamental turnaround, high fundamental floor, black swan market hedge, and incredible execution that also forces shorts to close. If you wanted to, you could also choose to view these numbers without the crazy, the 5x net asset value, 20%, like the present value of future raises. Like you could say, hey, I want to think about this as if that doesn't happen. Can I just look at like, what if this is how I value the asset management business, but everything else goes great? Again, if you wanted to do that, it's like, well, let me take 0.35%. And that's kind of what that number means to you is, hey, the asset management business is solid, but not wild town. And maybe it'd be helpful to illustrate that throughout this graphic a little bit more clearly, to say, hey, this is totally possible, but the better the market is, the harder it's going to be. But I mean, shoot, it's still pretty stinking exciting returns you're talking about. You know what I mean? So anyways, fundamental upside, still plenty of room to run. Risk of a downside at current levels, not a concern, but pretty soon could be not the most effective savings account, in my opinion, but then could be a great savings account again if we see another dip. Long-term performance-wise, guys, I've been talking. I think we have plenty of reason for great anticipation. That's why on this valuation tab, I give a weighted average price target. So in this portfolio tab, I'm talking about each scenario, and I'm imagining that you are dividing your own portfolio optimally according to different scenarios, and then you're sizing with your own probabilities to then use trade signals for different portions of your portfolio. If you want to skip that step, the valuation tab just takes a weighted average of all scenarios, right? If you take the weighted average, right, according to each probability of each outcome for each business line, right, you get your total valuation and your weighted average valuation. So on a weighted average probability basis, great case, right? Fly, fair, floor case, based on what we see right now. I guess if someone were to ask me, like, what's your price target? Like, just one price target, all things considered, here's the basket, it's GME. I'd say like a $48 billion market cap would be my current price target based on what we currently know. But that would change if we learned anything new, right? So that is about a 4x from current levels. But if you wanted to get level 2, you wouldn't just pick one number. You would say, well, why am I holding? Right? What outcome am I holding for? What is this position dedicated to? Most companies, you don't have to get this granular because there's only one scenario that it makes sense to hold it. There's only one risk reward that pays off. Most companies, you wouldn't say, I'm just going to put all my savings in blank. And also, I'm going to put all my YOLO dollars in blank. For that to be the same investment is confusing. It's very rare. That's why I encourage, that's why I'm spending all this time myself and why I'm offering this to you guys as a potential resource for you to utilize. So anyways, Project Burpee says his target is infinity. Great. Proud of you. If it's 100% of your shares, then, if it's 100% of your net worth and your price target is infinity, then there is a chance that you look like that one day, but it's probably not 100% of your net worth, and your price target's probably not infinity. You might think your price target's infinity, but as soon as you get to 999,999,999, I bet you might sell one share. You know what I mean? But again, I'm not here to tell anyone what to do. I gotta go. I'm running late. My wifey's probably like, what are you doing? I haven't actually heard from her yet, but surely she's thinking it. So I'm going to get out of here, go eat dinner with the boys and the daughter, 5 months old Lydia Rose. So cute. All right. Appreciate you guys. That's all I got for y'all today. I'll see you in the next one.